Hey guys, welcome back to the Bitcoin Fortress podcast. This is episode 203. Today is Sunday, February 15th, 2026. We are at block height 936776, Moscow time 1455. Fees are 1, 1, and 3 sats per VByte. This week, a clean way to frame it is orderly deleveraging and narrative warfare. Price volatility, ETF flow whiplash, Bitcoin-backed credit stress tests, and a renewed wave of Bitcoin origin stories, plus builders quietly shipping real tools. With that, let's get into the news. First, we will talk about market structure, price, and flows. Spot Bitcoin ETFs see a big outflow day, 410 million. Liquidity mirage framing. One ugly outflow day doesn't break the ETF trade, but it does reveal who's actually price insensitive and who's renting exposure. When flows reverse fast, it's usually macro positioning and risk desks degrossing, not Bitcoin is dead, but we keep hearing that. And if you're a Bitcoiner, this is just a reminder, the ETFs are a ramp, not the destination. Self-custody, still the point. From Bloomberg, 60K becomes the psychological and derivatives tripwire level. Watch how people talk about 60K. It's not mysticism. It's where leverage clusters. The danger zone is when the market believes a level matters and positions stack around it. Use it as a risk management lesson here, folks. Leverage longs get harvested first. But of course, if you're just staying humble and stacking sats, you're taking advantage of these nice low prices to build your position. And you certainly don't care if there is a rapid move down or up. Personally, every time I buy, it seems to go down. So that's cool. I'm cool with that. I'll just buy some more next paycheck at a lower price and until we reach the bottom, and maybe we're there, who knows. The Economic Times reported the dip and stabilize story. Longs liquidated, then Bitcoin consolidates around 70,000. Long liquidations are a reset button. Forced selling ends eventually. After a cascade, price often trades boring for a bit. That is the market exhaling. And for stackers, again, like we said before, this is where DCA discipline beats the predictions. Reuters reporting institutional macro crosscurrents. Equity fund flows show risk-off nerves. AI capex plus rate cut uncertainty. When macro's jittery, Bitcoin trades like a high beta liquidity in the short run, but in the long run thesis, it still doesn't change. Hard money wins when policy gets cornered. The signal here is markets are still fragile, and Bitcoin simply shows it faster than everything else, which is why you just have to stay humble and stack sats. Moving along to Bitcoin credit and collateral reality checks. First from the Wall Street Journal. Bitcoin-backed bond deal. Ledden Jeffries hits turbulence. Liquidations stress test the structure. This is what Bitcoin and its collateral looks like in the real world. Margin calls are not a theory. The good news, the structure is designed for liquidation. The bad news, it is brutal in practice. So, a quick takeaway for you all is if you borrow, assume volatility, respect loan to value, and plan for ugly wicks. My own thought is probably don't want to go more than 30% loan to value. And conservatively, maybe you borrow closer to 10 or 20. And then your likelihood of getting knocked out of the game or having a margin call would be a bit lower. But if you don't need to borrow, don't borrow. There you go. VanEck framing. This is from ETF and mutual fund manager VanEck. So a little article from them. February sell-off looks like deleveraging, not pure capitulation. The market can fall for non-Bitcoin reasons. Leverage and liquidity drive a lot of the move. Deleveraging is pain now, stability later. And if you're building conviction, you have to separate price action from protocol fundamentals. Moving on to regulation and policy, stablecoins and market structure. Lots going on in this space. Article from Paul Hastings on White House crypto meetings, Genius Act implementation chatter from a policy tracker summary. The vibe is lawmakers want market structure clarity, but stablecoins are the battlefield. Bitcoiners should watch the details because stablecoin rules can become backdoor surveillance rails. Clarity can be good unless it's clarity that says permission is required. Next from CoinDesk, crypto industry pushes stablecoin principles after TradFi reportedly pushes for yield bans. So this is the real tug of war. Banks want stablecoins caged. Crypto wants room to innovate. For Bitcoiners, stablecoins can be useful plumbing, but they're still fiat wrappers with policy risk. No different than holding digital dollars in your bank account. Maybe worse, because they're fully surveillable. Genius Act, primary source. So this is from congress.gov. Really just to help ground us here. Whenever a bill becomes a narrative, I like to anchor it in the text. Watch definitions and regulator scope. Definitions become enforcement. Bitcoiners don't need permission to run nodes, but rules can shape on and off ramps, and that is really the key focus here for all of us. For Bitcoin Magazine, pass crypto law this spring pressure campaign. Washington moves when markets scream, and they're starting to scream. If the pitch is pass it fast, our job is to ask, what did they trade away to pass it? And so that will be very interesting to see when this thing, I think it will cross the finish line at some point. But what new little gifts are in this legislation for all of us? Certainly more surveillance, because that just seems to be the theme du jour with our government, regardless of who's in charge. Next up, builders, shipping, privacy, custody, lightning, and covenant adjacent tools. So first, a little update from GitHub on Sparrow Wallet 2.4.0. Silent payment support, hardware wallet, PSBT fields, and usability upgrades. Quiet but important, tools that reduce address linkage and improve privacy hygiene. Privacy isn't one feature, it's a habit. And wallets that support better habits matter a lot. SigBash, oblivious signing idea, covenant-like constraints without a consensus change. This was on a TFTC discussion. If covenant debates feel stuck, builders route around with clever tooling. Separation of policy enforcement from policy knowledge is a powerful concept. Reminder though, innovation doesn't always require a soft fork of the Bitcoin protocol. This one from X, Amboss, Magma MCP, AI agent style lightning liquidity actions. This is a glimpse of where Lightning Network ops goes, automation and agent tooling. The risk, of course, convenience can create new trust assumptions. The upside, though, Lightning Network gets easier, which expands the real user base, which has continued to grow. In fact, I think I saw an article last week that somebody sent $1 million payment on the Lightning Network and it settled in like a couple milliseconds or whatever. So that's kind of a big deal. People are just paying for their coffee. Moving on to the narrative warfare and media cycles. So from Financial Times, the Trump rally wiped out framing. Trad media narrative shift matters. So watch how the headlines reframe the same asset depending on the price. In bull markets, it's inevitable. In drawdowns, it's over. Your edge is emotional discipline. Bitcoin is not a mood ring, folks. From Decrypt, ETF outflows plus liquidity pressure explainer wave. Decrypt is just one example of the mainstream angle. Media leans on ETFs because it's legible to legacy investors. Bitcoiners should translate the real story. Flows are short term, adoption is long term. And we can use this week as a lesson in custody, time horizon, and why we even own Bitcoin in the first place. Next up, let's take a look at the Bitcoin podcast universe. Several themes this week and some specific episodes that you might want to check out. The first one, of course, well talked about this week was that the bottom? Talking about macro, positioning, on-chain models. What Bitcoin did ran several episodes centered on the crash and what comes next. Joe Consorti was on, talking about volatility drivers, risk appetite, credit spreads, Fed policy, and ETF behavior. Checkmate in on-chain mean reversion models and whether the 60K event was an inflection point. I think even Urian Timmer from Fidelity came out and said he's not sure, but he thinks 60K could have been the bottom. Bitcoin will, of course, prove you wrong every time if you rely on that. So just stay humble, StackSats. Everyone's asking, of course, the bottom, but the more useful question is what got flushed out? If leverage got rinsed and flows stabilized, you get a healthier base. If macro tightens again, price can still sag, but that's not a Bitcoin failure. That's the macro. All right, moving on to theme 2 this week. Quantum FUD is back, and Dev Reality checks the timeline. Stephan Livera podcast hit quantum hard from a couple different angles. Matt Corallo, practical thinking on quantum resistant paths, slow adoption realities, consensus process. And James O'Byrne, skepticism toward the near-term threat, plus discussion of protocol dev pace, covenants, node tech like Assume UTXO, Utrixo, and Floresta. The reasonable stance is neither panic nor dismissal. Treat it like long-dated risk management. Bitcoin's superpower is careful change. That's also the frustration. Meanwhile, run a node remains the evergreen call to action. Theme 3, Bitcoin credit, growing up, semi-custodial models, LTV discipline, and stress testing. Again, Stephan Livera on Blockrise and the semi-custodial approach to lending and custody trade-offs. Wall Street Journal showing what happens when collateral structures meet real volatility. This week is a case study. Borrowing against Bitcoin is not free money. The only winning move is disciplined LTV plus a plan for violent drawdowns. They do happen. If you can't handle liquidation risk emotionally, don't play the game. Theme 4, protocol progress without a soft fork, covenant adjacent tooling. So TFTC number 714, arbed out, soft fork consensus challenges plus what comes after Taproot plus SIGBASH as a workaround concept. The ecosystem is learning to innovate at multiple layers, wallets, signers, policy engines, and that's bullish. Fewer all or nothing fights over consensus changes. Theme 5, AI plus Lightning practicality, agents doing real payments and real node operations. TFTC 714 explicitly discussed AI agents making Lightning payments. Rabbit Hole Recap 396 ran an AI will find replace us framing from the Odell Marty angle. The near-term AI plus Bitcoin reality is boring in a good way. Automation, payments, liquidity management, operations. The big question is, do we build it in a way that preserves self-sovereignty? Again, the age-old trade-off of privacy over ease of use, right? So it's really important as they build these things that we ensure that we don't create another centralization point of failure. And finally, theme 6, the Epstein Files origin stories wave, narrative attack surface. So what Bitcoin did with Mark Goodwin, talked about the Epstein Files and claims about Bitcoin's origins, plus stablecoins, dollar system framing. And TFTC 714 also covered the Epstein email leaks within a broader market protocol conversation. And whether or not you buy the framing, you need to recognize the pattern: attention hijack and emotional escalation. Bitcoiners should respond by building and teaching tools, custody, education, lightning, and privacy. Don't let the lore wars replace the actual mission. This week's featured Substack post, Who Owns an AI's Bitcoin? Really, the core question is, if an AI can generate value, open up its own wallet, and transact, who owns the proceeds? There's really 3 layers: keys, which is control; possession is ownership and practice; the legal personhood lag, the law will trail reality. And in fact, one of my readers reacted rather strongly to the notion that the authorities would even allow an AI to have an account, and that's certainly true in the TradFi sense. There would, KYC and all that not happening, but the Bitcoin protocol doesn't. It really doesn't care, and it could let anybody open up, so to speak, open an account, right? You just create a wallet, you start doing something of value, you receive money in Bitcoin, and all of a sudden you've got Bitcoin. Custody architecture matters as well. So multi-sig, guardians, agents, limits, and all that. Again, this kind of ties back to an overall theme I talk about quite a bit, which is that Bitcoin forces clarity. Ownership is operational. It is not rhetorical. So if you're interested, check that out. Link in the show notes. Also link in the show notes to all the articles that we reviewed this week on the podcast, if you want to dive deeper. Speaking of diving deeper, if you do want to go even deeper, check out my 3 Bitcoin Fortress books on Amazon. Links in the show notes, built for real people who want practical understanding, custody, conviction, and living on a Bitcoin standard. which I myself have tried to do as much as I can in this crazy fiat world that we live in. And so this week, well, it was deleveraging, policy theater, and builders shipping. Stay humble, stack sats, and keep your keys, folks. Hope you enjoyed the podcast. Please give us a rating, review, share. Check out the Substack. Thank you for supporting the show. And with that, I will talk to you all next week. Bye-bye.